The Fed strategy. We know that the goals of the Fed are to keep the prices stable and to maximize employment. And we will now look at how the Fed does it and what its strategy is. So the Fed can influence the short term interest rate. Interest rates here represent the cost of borrowing money. If you were to borrow $10,000 to buy a car, you would have to repay more than $10,000 to the bank, and the extra amount that you give is the interest. And so let's say if you pay 5% extra to the bank, the interest rate was 5%. By managing the short term interest rate, the Fed can determine how much credit is available, how much loan can be made by banks to businesses and households. And they can also influence the cost of credit. If interest rates are very high, then the cost of getting credit, getting loan is high, and that has consequences. Through monetary policy, the Fed directly affects short term interest rate, and indirectly, it also affects longer term interest rate. So, for instance, for loans that are over several years, like mortgages, for instance. It also affects currency exchange rate. So the exchange rate between the dollar and the Japanese yen, for instance. It also affects the price of equity or assets. Equity or assets represent items of value that are owned by businesses or households. So this would include stocks and bonds, houses, buildings, machinery, and so on. As a result, the Fed can also influence household spending and investment, and therefore production of goods and services, as well as employment and inflation. So, for instance, if interest rates are very high, households are likely to spend less, buy fewer things, borrow less money, so fewer houses, for instance. Businesses are likely to carry out fewer big investment projects. And that means that less will have to be produced in the economy, fewer goods and services, which means fewer jobs, and also the fact that prices are not likely to rise much, so low inflation. So to summarize, the Fed influences the very short term interest rate, like intrabank interest rates, rates that banks charge each other. But that in turn influence other short-term interest rates, such as the interest rate you pay on your auto loan or the ones you receive on bonds. Bonds here are investment items that are like an IOU. And that in turn influence the longer term interest rates, such as your mortgages and longer investment project. And it influences production of goods and services in the economy, investment, household spending, jobs, and inflation. Here's a graph that shows over time various interest rates, right? So it's from the 1980s all the way to 2019. And in blue, you have the federal fund rate. That is the interest rate that banks charge each other. That's the one that the Fed can influence. In red, you have the prime rate, which is the interest rate that banks will charge their best customers. And then in the purple, you have other short-term interest rates, such as auto loan. And you can see that these interest rates closely correlate with one another. They closely follow each other. For instance, if the federal fund rate is rising, the prime rate is also rising, and the other short-term interest rate tend to also do the same thing. And that's how the Fed influence more than just the very, very short-term interest rate. There is a trickle-down effect to the other interest rate. Who makes those decisions at the Fed? Those decisions are made at the Federal Open Market Committee. or the FOMC. The FOMC includes all the members of the boards of governors and the presidents of the Federal Reserve banks. The president of the Federal Reserve Bank of New York always votes, and four of the other remaining reserve banks take turns in voting at those meetings.